Hello and welcome back to Vidsick here. Today we are going to discuss a very important aspect of mutual funds, that is its tax implications. Now before we begin, make sure you have subscribed to our channel Vidsick here and hit the like button so that YouTube may show this video to more and more people. For those who have missed out on the previous videos, here's a quick refresher. Mutual funds are investment vehicles that pool money from multiple investors to invest in a diversified portfolio of securities such as stocks, bonds, money market instruments, and other assets. These funds are managed by professional fund managers who make investment decisions on behalf of the investors. Mutual funds offer investors the opportunity to access a diversified portfolio of securities, even with small investment amounts, and benefit from professional management expertise. Taxation of mutual funds in India varies depending on factors such as the type of mutual fund, the holding period of the investment, the type of income earned. Understanding the distinction between short-term and long-term capital gains is essential for investors to plan their investment strategies effectively and optimize their tax liabilities. It's advisable for investors to consult with a tax advisor or financial planner to make informed decisions based on their investment goals and tax implications. Short-term and long-term capital gains refer to the profits made from selling capital assets like stocks, bonds, real estate, or mutual fund units after holding them for a certain period of time. In India, the period of holding determines whether the gains are categorized as short-term or long-term, and this classification impacts the tax treatment of the gains. Short-term capital gains, or STCG. Short-term capital gains are the profits earned from selling capital assets that have been held for a short duration, typically up to a certain period defined by tax regulations. For most types of assets, including equity mutual funds, assets held for less than 1 year are considered short-term. In the case of equity mutual funds, in India, gains from units held for less than 1 year are classified as short-term capital gains. Now, short-term capital gains are usually taxed at a higher rate compared to long-term capital gains. In the case of equity mutual funds, in India, short-term capital gains are taxed at a flat rate of 15%. Long-term capital gains, or LTCG. Now, long-term capital gains arise from the sale of capital assets that have been held for a longer period, typically exceeding a specified threshold defined by tax laws. The holding period required to qualify for a long-term capital gains treatment varies depending on the type of asset. For equity mutual funds, assets held for more than 1 year are considered long-term. Long-term capital gains are often taxed at a lower rate compared to short-term capital gains to incentivize long-term investment. However, long-term capital gains on equity mutual funds above rupees 1 lakh in a financial year are taxed at 10% without indexation benefits. For debt mutual funds, assets held for more than 3 years qualify for long-term capital gains treatment, and they are taxed as per the tax slab. Here's a general overview of the taxation of mutual funds in India. Equity mutual funds. Short-term capital gains If equity mutual funds are held for less than 1 year, any gains realized from selling them are considered short-term capital gains and are taxed at a flat rate of 15%. Long-term capital gains. If equity mutual fund units are held for more than 1 year, gains above rupees 1 lakh in a financial year are taxed at a rate of 10% without the benefit of indexation. Debt mutual funds. Short-term capital gains. If debt mutual fund units are held for less than 3 years, any gains realized from selling them are added to investors' taxable income and taxed at their applicable income tax slab rate. Long-term capital gains. If debt mutual fund units are held for more than 3 years, gains are taxed as per the tax slab. Tax saving equity linked savings schemes or ELSS. When it comes to ELSS, there is a mandatory 3-year lock-in period, and at the same time it comes with 2 options. If we select the old tax regime, investments in ELSS mutual funds qualify for tax deduction under Section 80C of the Income Tax Act, up to a maximum limit of rupees 1.5 lakh in a financial year. Whereas under the new tax regime, there is no such provision. You can avail tax exemption of the invested amount up to a limit of rupees 1.5 lakhs, and the income that you earn at the end of 3-year tenure will be considered as long-term capital gain and will be taxed at 10% if it is above rupees 1 lakh. Dividend distribution tax or DDT. Dividends distributed by mutual funds are subject to dividend distribution tax before being paid to investors. However, as of April 1, 2020, the Finance Act 2020 abolished DDT and dividends are now taxable in the hands of investors at their applicable income tax slab rates. It's essential for investors to consult with a tax advisor or financial expert to understand the specific tax implications based on their individual circumstances and the prevailing tax laws at the time of investment. Additionally, tax laws and rates may change over time, so it's crucial to stay updated with the latest regulations. So this is a brief overview of the tax implications of mutual funds. I hope you find this video informative and insightful. I would love to hear your views in the comments below. For more information from the world of finance, do subscribe to our channel with Sikya. Thank you for watching. See you in the next video. Till then, happy investing.